Thank you, Mark. Again, one of the first steps to selling a business owner would have is, well, how much is my business worth? And I think one of the commonly bandied about things I hear is, well, just 2 times your profit. But really, there's so much more to a business valuation, just 2 times the profit. So I'm going to discuss some of the factors that go into that to help you guys understand how and why businesses get valued the way they get valued. So the number one factor is that basically, as you can imagine, every different industry commands different multiples. So I'll give you some basic examples. We'll take billboard advertising companies. They would often sell for 12 times the EBITDA. And then we can take, let's say, a retail bakery. Those would typically sell 2 to 2.5 times the SDE plus inventory. And then let's say injection molding companies. They would be selling for typically 4 to 6 times the EBITDA. And then Burger King franchises, for example, they usually have annual sales plus inventory. So as you can imagine, it's kind of all over the map, and it varies by pretty much every industry. So the next question is, well, what are all these terms? EBITDA, SDE, and all that other stuff. And that gets into the second factor that affects kind of multipliers, which is, what is the definition of profit? Are we just considering the bottom line profit that somebody would show in their tax return? The issue with that is, well, a CPA is going to advise their clients to definitely write off as much as they can legally to reduce their taxable profit so they pay less in taxes. So there's a couple different numbers that we use to value businesses with. And number one is called EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And what that does is we take the bottom line tax profit and we add back the expenses that are written off for depreciation, amortization, interest expense, and taxes. So that's kind of more of a true profit of the business. Another one that we commonly use is called the seller's discretionary earnings, which is SDE. It's pretty much EBITDA, and we also then add back a fair market value salary for the owner. And that applies in more what we would call Main Street businesses. After we've kind of fleshed out which term we use or which profit figure we use for the business, then we get into all the other factors that really play effect into the value of business. So even when we're comparing 2 manufacturing companies or 2 moving companies, there's not always an apples-to-apples comparison, and that gets into the organizational structure. If you have one company where the owner is wearing almost all of the hats versus the other company in the same industry where it's very well structured with the management structure in place and everything's very orderly, the company that's much more organized is going to get the higher multiplier. So that also plays into the fact that it's not just as simple as, oh, look it up online and see, okay, 2.5 times this. I must be 2.5 times that. Sometimes it's higher, sometimes it's lower based on these other factors. Another very important factor is going to be barriers to entry. As we all know, some businesses are pretty easy to open up and start within a week, and then some take some time. So for example, you have some businesses that require an extensive build out, an extensive permitting process. If something like that is going to take 6 months or 12 months, you know, time is obviously money, and there's carrying costs in that, so sometimes that will drive up the value of other businesses that are for sale. They're already set up and ready to go. One specific example would be businesses that have spray booths. Those would be things like auto body shops, powder coating businesses, and then sandblasting businesses. If you have a spray booth, you have to have a permit with the AQMD. And basically here in Southern California, it's basically next to impossible to get a new permit. So any business that has a spray booth basically has a very high barrier to entry, which means they have an increase in value and they can get a higher multiplier. Obviously, another really important factor is just the overall risk involved in a business. So for example, what is the long-term trend in the industry? As we can imagine, 20 years ago, businesses that sold CDs and vinyl records, you know, they had a decent future, but once MP3s came out, the long-term prognosis was way down. So that's important when we look at any business to see what is the long-term prognosis for this business. Is it good? Is it steadily declining? And that also factors into where we push the multiple, whether it's down or up. Another important thing that any business can have beyond that is then just customer concentration. If we have a business with too many eggs in one basket, meaning the business only has one or two customers responsible for more than 50% of their revenue, there definitely is some significant risk there, because if the buyer takes over, there's no guarantee those one or two customers may stay, and all of a sudden the business goes from very valuable to hardly valuable at all. And so, those are just a quick summary of kind of some of the factors that go into a business and its valuation. Thank you, everybody.